Now let's look at where people normally invest their money. So first we will look at fixed income instruments. These are basically fixed deposits, government bonds, where you get a fixed rate of return. However, if you look at the average return that you make on these investments, it is not more than 8 in a reasonable market to 11% in a very good market. Considering the current scenario, I would say that you will not make more than 6 to 7% in the fixed income instruments. Now coming to real estate, so that is basically property. People end up buying property also. People who have good amount of capital in their hand basically appreciate uh, in flats or probably land or probably a house. Now, the kind of returns people want to look over here is for appreciation value of the property or probably getting a rental income. But if you analyze this in the current conditions, or probably matter in the regular conditions also, the real estate market takes large amount of time to get you any good returns. Plus, in the volatility today and in the super inflated market today, real estate is also not very conducive. Okay, we've seen that there is a 7-year cycle that goes on in the market, in the real estate market, but that is basically, you don't need to get too much into it. Okay, basically what we are trying to say over here is that real estate market does not give consistent returns on the investment. Next comes commodity. Okay, something like gold or silver. Now people tend to buy gold, silver also as investments. Okay, the returns in gold and silver will also be not more than say 8% in a regular market. And then coming to equity. So if you analyze the last couple of decades, you will see that equity gives you at least 14 to 15% returns every year. This is on a conservative side. You can make at least 20% a year if you invest in decent stocks. Okay, but at a very conservative side, you will make at least 14 to 15% every year.